Mark, well, a happy Monday morning too. I wanted to chat with you on some domestic issues. Before we do, though, I think you've probably been listening to John talking about Europe. I wanted to get your thoughts. We spoke last week about the spectre of Europe still very much playing on investor minds. I mean, do you see that continuing? It seems you have this sort of almost this confronting forces, positivity over the US earnings season at the moment, offset to some degree by the constant realisation that shocks out of Europe can come at any time. Sure,
and I think that's been the story for the last year, if you like, the fact that the Americans have started to adapt, and it's consistent with the way we see the American corporates are starting to behave in a manner that they go for profit first, and the workers can deal with the consequences of going for profit first. So they're not like the politicians having to appeal to the political group. But the thing that was interesting to me about France and the continued volatility in Europe was Le Pen. John, what do you think about that? The fact that the nationalist vote was so high as well. So you have the socialist vote on one side, and then you have Le Pen on the nationalist, and the reaction to the anti-immigration policies and all we go back to the 80s to some extent, where we're not just anti-business, we're anti-immigration, we're anti-everyone. So that's of greater concern, I think, to the investor community, where it's hard enough to see people getting their houses in order. These countries can't seem to have a roadmap or a narrative as to how they want to evolve.
John, your thoughts on Le Pen's surprisingly strong showing?
Yeah, and much stronger than her father's showing a few years ago. I think the polls are saying close to 20%. I think really what it shows is, too, and we're seeing this, we'll see it in the states when they have their federal election, the divide or the polarization of politics between the right and the left, where the leftists seem to get more extreme, and the more extreme they get, the more extreme the right gets. That makes it very, very difficult to govern. And so that makes the job of whoever becomes president of France and whoever becomes president of the United States a very difficult one.
Todd, I want to bring it, Mark, sorry, I want to bring it back home to what we're seeing this week. Some important things coming out, starting very much on Wednesday for us. The CPI, now there's so much focus on this ever since the RBA has pretty much flagged it as the key moment, the watershed moment as to the next rate cut if possible.
Correct. I think every taxi driver in the country knows that when that CPI comes out, and if it's at 0.5, they know they're going to get an extra $4 a week. Depends on how much the banks pass on. But I think everyone is of the view that there'll be a rate cut. I think the RBA has set it up so that they're predisposed towards it, and so I think they'll just follow through it. It'd be hard to imagine it's going to be higher than 0.5 in terms of an inflation number, and a year-on-year around 2%. To 2.2. So I think the RBA will be comfortable in having made the message available to everyone and then just following through on it.
Worth noting that CPI reads on Tuesday, because obviously we'll all be playing 2 up on the Wednesday for Anzac Day.
Sorry, I beg your pardon,
What about your thoughts, John? Is there any chance we could see something come in that would give the RBA pause, if you like, for a potential cut?
Oh, I think it'd have to be way above expectations. Something above 2.5%. And they look at, of course, the underlying inflation rate, the weighted mean and the trim mean, and I really, all the lead-ins to this number. All the inflation gauges, the TDMI, et cetera, they're not suggesting that this number is going to be a very hot number at all. So it would have to be something right out of the box for them to cause pause. And I think it's pretty much a done deal that they will lower rates.
Mark, 25 basis points. I mean, some people argue it should be more than that. And then when you take into the fact that the role the banks play, particularly as to whether or not they'll pass on the full amount, that sort of potentially strengthens an argument for more than 25.
That's right. It's very hard to imagine the RBA moving more than 25. And if it did move more than 25, it would need to have Governor Stevens be very clear on the reasons why, because he doesn't want to spark, a quasi-panic. He doesn't want, when he sees soft economic data on the eastern seaboard, he doesn't want to accelerate that nervousness around, we need 50 basis points to stimulate growth because things are very bad. Now, if in the event he said, we saw cost of funds to banks being more expensive, and so therefore as a consequence we're moving 50 basis points because we know you'll only get 20 to 25 basis points passed through, that might make a more interesting story and people might accept that. But if he said it was 50 basis points because Europe is about to go into a bucket and we're all in trouble, then that would lead to further rate cuts or further expectations of rate cuts.
Mark, John Linden from Thomson Reuters. We also have the FOMC meeting this week, and Treasury yields, or the 10-year Treasury yield, which I watch fairly closely, when it blew out towards 2.30% in March, I thought, well, maybe this is the end of the bull run for Treasuries. The bubble of Treasuries might burst. Now we're back at 1.95% again. What do you think the Fed meeting is going to bring? Do you see any change at all to their projections or their statement, or do you think it's going to be a non-event, or do you think it could be a market mover?
I think it's not necessarily ever a non-event. It's just a matter of whether they're consistent with their story, and I don't see Bernanke changing his story one iota, because that's what's driving some of the growth that he sees external to the corporate activity. So the corporates in America are really adapting to this low cash environment, and they're keeping a lot of the money. They're not leveraging their balance sheets, they're keeping it. What he needs to do is stimulate economic growth around the employment piece, and the one driver of employment is the housing market. That was the thing that brought it all down. That's the thing that he needs to stimulate. Therefore, he needs to have a long bond that is at a lower rate, so you can have a mortgage that's under 5%, and he won't let that finish for the next 2 years. You will see some volatility around expectations, but I think when he goes to bed at night, if the long bond is if the mortgage rates are under 5%, he's comfortable. That will stimulate a range of growth in America.
John, your thoughts?
Yeah, well, it's one of the reasons I watch the Treasury yields very closely is because I believe that if the stock markets are going to really take off, you're going to need that money leaving the safe haven interest. So I don't know whether the stock market is going to take off by the Treasury bubble bursting, or the stock market taking off will force people out of Treasuries. So, but I think Mark is right. I think as far as the Federal Reserve is concerned, they like the yields being nice and low, and while the Federal Reserve has the markets back on Treasury yields, I don't think the investors or some investors are going to move out of fixed interest in a hurry for fear of yields moving higher.
But we're going to have to leave it there and head to a break. So a big thank you to Mark Todd from FIIG Securities for his time today. Mark, always a pleasure. Thanks a lot.